When everyone on YouTube, including your dear Aunt Sally, is calling for a stock market crash or recession, it may be time to think about those boring, stable, consistent companies that pay cold, hard cash on a monthly or quarterly basis, just for you being you. Seriously, you can literally go to the beach and just sip Mai Tais all day. Oh look, a carrier pigeon has just come to give me my monthly dividends. In today's video, we will discuss the top 4 dividend ETFs to buy now. They will range from the safest, lowest yielding dividend ETFs to the higher risk, higher return dividend ETFs. I chose my absolute favorite dividend ETFs for every style of investing, so you can choose the one that best balances out your personal stock portfolio. All sizes are not the same. Be sure to stay until the end of the video to see which dividend ETF gets the Olympic gold medal and which one gets the highly coveted participation trophy. Now you may be thinking, Raylan, I only want a super mega pint high growth stock that only goes to the moon. Why would I want to invest in these boring, young-like companies? I don't want to invest in these dividend ETs. In which case I would respond with a Stranger Things quote and then let you know a brief summary of what a dividend ETF is and its benefits. An ETF, or exchange traded fund, is a publicly traded fund that tracks an index or category in the stock market. A dividend ETF is designed to invest in a basket of dividend-paying stocks, or simply has a strategy that holds many stocks and gives investors income on a monthly basis. To sum it up, it's basically like owning a mall that has a Louis Vuitton, a nail salon, a Macy's, a Nike, all those things I can't afford because I want to invest my dividends and reinvest them, and getting paid a monthly or quarterly consistent percentage just for owning these stable stalwarts in the mall. This year has been a little rocky, with individual stocks going down 40, 50, 60, 70, 80% yield to date. But the dividends just keep coming in. So now that we know what dividend ETFs are, let's look at 3 benefits or reasons why you may want to hold dividend ETFs over stocks or individual dividends. Number 1, safer investment instrument. While individual dividends may fluctuate like a roller coaster of life, dividend ETFs have more spices of life, aka that word that makes any investor sleep better at night. Diversification. Dividend ETFs may be a safer choice, especially the 4 that I just chose, because they have a wide array of companies in which they have invested. Instead of putting all of your eggs in one basket, have a scavenger hunt. Invite your neighbors. Actually, don't do that in New York. Please don't. That's a terrible idea. If you invest in a dividend ETF instead of an individual dividend, you won't have to worry about companies like AT&T, ticker symbol T, who cut their dividend in half last year and the stock price dropped substantially before anyone could sell. Even if a company in your dividend ETF shocks the world, your cash flow may drop, but it would only be slightly. Number 2, recession and market crash resistant. While Tom Cruise's F-18 can, spoiler alert, complete his mission in the most dire of circumstances, so can your portfolio. While we currently have record-breaking inflation and economists have predicted that the odds of a recession have increased by 28% in the next 12 months to 44%, we need to have a safety net to weather the storm for our investments. Dividends and dividend ETFs provide a great way to hedge against recessions or huge bear markets with stock prices plummeting. All you see is red all day, error day. Because even if the stock price goes down, there's a very high chance that the dividend will continue to flow. This means that while individual stocks are selling off like hotcakes, investors can enjoy some extra cash. So they have some extra cash reserves that they can wait until there is a market bottom to have some of that dry powder, or they can reinvest. Number 3, better balance. Last, dividend ETFs create harmony and balance in your portfolio. Companies who have a track record of 1, 2, 3, even 4% dividends for the past 5 years and increasing are usually very stable, secure, and consistent. Of course, you need to research each company, but as long as that company has a 5 to 10 year track record of a good dividend that is steady, that is increasing with a nice payout ratio, you can expect to have a more balanced portfolio with good dividend income coming in. The top dividend ETF we have is the Schwab US Dividend Equity ETF, or ticker symbol SCHD. This is a great steady ETF because it only invests in stocks that have at least a 10-year track record of paying out dividends. It tracks the total return of the Dow Jones US Dividend 100 Index. The dividend yield is currently 3.10% with a low cost expense ratio of 0.06%. It is currently $72.61 with a 52-week range of $69.86 to $82.48. Net assets are $36.7 billion, so very steady, and we have seen a 100% increase in the stock price within the last 10 years. It currently has 104 holdings, and top holdings include Merck at number 1, Verizon, Amgen, Pepsi, Coca-Cola, IBM, and Home Depot, so very well-known brands. It has a 21% exposure to financials and a 20% exposure to information technology, IT. Its portfolio is mostly allocated to financials and information technology. Next, we have exposure to consumer staples, healthcare, and industrials. SCHD contains companies that mainly have a large market cap, with 61% of its holdings having a market cap of more than $70,000 million. Larger market caps usually indicate older, more established companies that have consistent revenues with a steady dividend. So if you're looking for something safe and consistent as far as dividends are concerned, this is a great option. Looking at its dividend history, we can see a steady increase in dividends throughout 2013. It started at a 22-cent dividend in 2013 to 24 cents in 2014, 27 cents in 2015, 32 cents in 2017, 35 cents in 2019. Notice the steady, slow increase, which is great for dividend investors. And it even increased during 2020, and it was non-stop, and is currently at 70 cents in 2022. This shows how resilient the passive income is for shareholders. With a great return on stock price and a steady dividend, ticker symbol SCHD is one of the best recession-proof dividend ETFs on the market. The second dividend ETF is Vanguard's High Dividend Yield ETF, ticker symbol VYM. This tracks the FTSE High Dividend Yield Index, which measures the investment return of companies with high dividend yields. This is a great ETF for investors who want higher cash flow from dividends that are higher than the S&P 500. There are no real estate investment trusts or REITs in this ETF, so if you're looking for a REIT, you will have to buy individual REITs along with this. And it holds companies with mid and large market caps that are classified as value stocks. The dividend yield is 2.72% with an expense ratio of 0.06%, just like ticker symbol SCHD, although this has been on the market for a little bit longer. It is currently $103.04 with a 52-week range of $98.63 to $115.66. Net assets are $58.82 billion, and the stock price has increased 66% in the past 10 years. If you're looking for a highly diversified ETF, this is a great option. It currently holds 443 companies, so about 4 times more than SCHD, which is one of its pluses if you're looking for diversification. Top 10 holdings include Johnson & Johnson at number 1, ExxonMobil, JP Morgan, Procter & Gamble, and Chevron. So we have a lot of well-known names combined with oil and pharmaceutical companies at the time of this recording. I also find this interesting because Warren Buffett has been aggressively buying oil stocks as well. Financials and healthcare are the top sectors in this ETF, with an exposure of 20% for financials and 14% for healthcare, respectively. Other prominent sectors include consumer staples, energy, and industrials. It currently holds only U.S. companies. Looking at its dividend history, we can see a similar happily ever after story since 2013. In 2013, the dividend was 41 cents. In 2014, it was 40 cents. A little bit of a dip, but not that bad because it made up for it in the rest of the quarters, and it pays quarterly. 2015 was 46 cents, 2017 was 56 cents, 2019 was 65 cents, and while 2020 was a bit rocky, we did see an average dividend increase still. And currently in 2022, the dividend is 84 cents. So again, it's recession-proof resilient. I would definitely say that SCHD and VYM are like twins, and they are both good options. If you're looking for a dividend ETF that is steady and you can buy and hold forever, this is a great option. Comment below if you prefer VYM or SCHD. While both stocks are like daughters to me and it's hard to choose a favorite, it may be beneficial to cut one off. Credit card declined, because this next strategy could help you pay taxes like a millionaire. Tax loss harvesting is a strategy that can help investors minimize any taxes they may have on capital gains or their regular income. For example, if ticker symbol SCHD had a bad year and you decided to sell it, you can actually get tax advantages on your capital gains due and thus get a better return. The only problem is if you want to buy back ticker symbol SCHD, you're not allowed to do so for another 30 days. Otherwise, you don't get the tax advantage. This is called a wash sale, essentially meaning you won't get the tax break. So for savvy investors who want the best of both worlds, you can basically sell your underperforming ticker symbol SCHD and buy back T-minus anytime that you want into the next two dividend ETFs that I talk about in the next part. You can do this anytime you sell, and it is all kosher with the IRS. So you can still have a great dividend ETF and get your tax advantage. One caveat to this is not buying a substantially identical asset, meaning you are not allowed to buy a stock that is similar to the one you just sold. So if you want to sell ticker symbol SCHD, then you can buy back into another dividend ETF, ticker symbol qyld, that has a completely different covered call strategy, and you can do that at your leisure. This is definitely a great strategy. It's kind of one of those ninja bonus strategies to look for when it comes to your investing portfolio and to get even better increased returns. The third top dividend ETF is the JP Morgan Equity Premium Income ETF, ticker symbol JEPI. Unlike SCHD and VYM, which pays dividends quarterly, this ETF pays cash flow monthly. This is a very interesting ETF because it follows a very different strategy than SCHD and VYM. It selects stocks on a proven bottom-up research process with stock selection based on proprietary risk-adjusted stock ranks, which is just legal jargon for we choose great stocks but won't tell you our secret sauce, and uses options overlay that flexibly adjusts with the current market. So it uses stocks and options to generate its attractive current yield of 7.5% dividends. jepi is an actively managed fund with an expense ratio of 0.35%, which is high, but the 7.5% dividend more than makes up for it. jepi's main goal is to seek current income while maintaining prospects for capital appreciation. So while it's looking to generate income for dividends, it's also looking to grow capital. Its main strategy is a bit different than a covered call strategy like ticker symbol qyld, because it seeks to provide the majority of returns associated with the fund's S&P 500 benchmark index while exposing investors to less risk through lower volatility and still offer incremental income. In order to do this, they invest in stocks with a lower volatility than the S&P 500 and ELNs, or equity-linked notes. This basically means it seeks to provide investors with S&P 500 returns with lower swings in stock price and monthly dividends that are steady, and may invest up to 20% of net assets into ELNs, which are basically like strip bonds, or a debt instrument where the principal and regular coupons are sold separately, with a call option on a specific security. jepi is currently $56.12 with net assets of $9.83 billion. It has a 52-week range from $52.54 to $63.67. Top 10 holdings include Progressive, Bristol-Myers Squibb, which just had a 52-week high on Friday, AbbVie, and Hershey, along with ELNs and call options. Its holdings are mostly exposed to the healthcare and consumer staples sectors. Healthcare accounts for 12.8% of its portfolio, while consumer staples account for 11.9% exposure. Since jepi is a new kid on the block, its dividend history is brief. In 2020, the dividend was 49 cents. In 2021, it was 26 cents. And currently, it is 51 cents. Of course, we had a few special dividends, so this varies a bit. While it did pay a dividend throughout 2020, the dividend has fluctuated and returns have been more volatile than SCHD. While the dividend has ebbed and flowed each month, the 5-year average dividend yield is 7.51%. Now, this 7.5% is average, and it is what I'm expecting for the next years to come because I believe that management has a very solid process, and I believe that 2020 was kind of a fluke year, and that is when they started. If you're looking for monthly cash flow, a high dividend, and reduced volatility, this is a great option. Just be aware the dividend may fluctuate monthly, but hopefully stay as an average of 7.5% or increase. And this ETF is a bit newer, so we don't actually have a long track record on performance of the stock. The last top dividend ETF on this list is the Global X Nasdaq 100 Cover Call ETF, ticker symbol QYLD. This is a cover call dividend ETF that owns all of the stocks in the Nasdaq 100 and sells at-the-money call options on the Nasdaq 100 every month. This is in order to maximize option income received. Selling cover calls is a great strategy that I personally use to generate additional income on my dividend stocks. It is an incredibly low-risk option strategy, with the only downfall being investors may not receive as much capital appreciation as investors that just own shares if these stocks unexpectedly rocket to the moon in share price. QYLD is currently at $17.62 with a dividend yield of 12.08%. Net assets are $6.85 billion with a 52-week range of $17.01 to $23.15. Since it tracks the Nasdaq 100, its portfolio consists mainly of technology. Top 10 holdings include the FANG stocks with Apple, Microsoft, Amazon, Tesla, and Google. QYLD's dividend history, while volatile, has paid dividends every single month. In 2014, the dividend was 25 cents. In 2015, it was all over the place from 15 cents to 23 cents. In 2016, it was 12 cents to 22 cents. From 2018, it was higher with 17 cents to 24 cent range. And 2020 was fairly steady around 19 cents. Currently, in 2022, it is at 17 cents. QYLD dividend fluctuates from 13 cents to 25 cents and is quite volatile. While the yield is very attractive, the dividend swings may be too risky for your portfolio. Investors also must be aware of the capital appreciation. QYLD is currently down 30% after 10 years on the New York Stock Exchange. Capital has steadily depreciated throughout its history. If you're looking for dividend growth, this is not the right ETF for you. Investors must also understand this is a riskier asset than all of the other ETFs due to its underlying assets. The Nasdaq 100 is very tech-heavy, and therefore it is not a great hedge against inflation, quantitative tightening, or higher interest rates. If you are looking for steadier dividends and possible increases in capital appreciation, ticker symbol XYLD, which is the Global X S&P 500 Cover Call ETF, may be a better option for you. If you just want a very high dividend yield for monthly cash flow and believe tech will continue to dominate the market even with higher interest rates, this may be a great ETF for monthly dividends. While I would love to tell you there are absolutely no catches to dividend investing, there is one factor every solid dividend investor must know before investing in a dividend ETF. This goes way down to the nitty-gritty of tax implications. First, we need to know what kind of account are you receiving your dividends in. Any type of tax-deferred account for retirement or kids like a Roth IRA, 401k, SEP IRA, or 529 plan allows for dividends usually to not be taxed. You may be taxed on withdrawal on distributions, but if you have a Roth IRA, withdrawals on distributions will not be taxed at all. An exception to this rule are those sneaky MLPs in the form of unrelated business taxable income, or UBTIs. They may be taxed even in a tax-free account if distributions are over $1,000. Luckily, dividend ETFs do not have UBTIs, so we don't need to worry about them in this video. Next, we need to judge these dividends harshly and put them into either Hufflepuff or Gryffindor. So we're going to show them as qualified or non-qualified dividends. A qualified dividend is a dividend that falls under the capital gains tax rates that are lower than the income tax rates on unqualified or ordinary dividends. Qualified dividends are taxed at rates of 20%, 15%, or 0% depending on the tax bracket, while non-qualified dividends or ordinary dividends are the same as the standard federal income tax rate, which range from 10% to 37% for 2022. To qualify for qualified dividends, you must meet 3 criteria. Number 1, the dividend must have been paid by a U.S. company or qualifying foreign company. Number 2, the dividends are not listed within the IRS Black Book as those that do not qualify. And number 3, the holding period is met. This means that investors must hold shares for more than 60 days during the 121-day period that starts 60 days before the ex-dividend date. If you're confused, just remember to hold, for example, ticker symbol VYM for more than 61 days if you have received a dividend from it. It's just a rule to make sure dividends don't become pump and dumps, pumping right before the ex-dividend date and dumping the next day. Also, basically just hodl and you'll be fine. Of course, I'm only an NYU finance major, so please consult your accountant with any questions. I don't know. I'm some woman on YouTube. This is entertainment, not financial advice. Another classification we need to mention is return of capital, or ROC. This is a payment or return received from an investment that is not considered a taxable event and is not taxed as income. This comes from the company's NAV, or net asset value. Companies will use ROC as dividends if they want to keep dividend yields steady or want to compete with similar companies. For investors, if a dividend is qualified as ROC, this means you will not be taxed because on paper you're just getting the money you initially invested. While this doesn't impact taxes in the short term, it will affect your adjusted cost basis. For example, if you buy 1 share of ticker symbol QYLD for $15, I wish, your cost basis is $15. You get a 10% dividend for the year of $1.50, which is classified as ROC. This means you have to subtract that $1.50, so your new cost basis is $13.50. Math. You still have 1 share, but if you ever decide to sell your shares, you will have to pay that $1.50 in the terms of capital gain taxes. You will pay short-term or a long-term capital gains tax depending on how long you hold the shares. So ROC is essentially tax deferred, which means you only pay taxes when you sell shares. Sounds like I'm going to have to diamond hand for no particular reason. Of course, once your adjusted cost basis reaches 0, you will need to pay long-term capital gains on your distributions. We need to also know whether the dividends will be considered short-term or long-term gains. Typically, when you hold a dividend longer than 1 year, you will pay long-term capital gains, which is lower than the short-term capital gains taxes you would pay if you sold your stock before 1 year. Long-term capital gains tax is 0%, 15%, or 20% respectively, while short-term is ordinary income. Okay, so let's look at ticker symbol QYLD. It's a hot mess. So it changes its tax type often, which is something to be aware of. To make sure you know the exact tax type, I have a link below that you will need to go to make sure you know what the tax type is. So this goes by month, and we can basically see the one for June. The record date is June 22nd, pay date June 29th, and we can see the categories of the different tax brackets. So we can see the net investment income is 0.0022 and it's 1.27%. We have net realized capital gains, which is 0.1713 at 98.73%. Return of capital is 0, and then the total dividend that you received is 17 cents per 1 share of ticker symbol QYLD. So mostly is net realized capital gains. It is not investment income, at least for record date June 22nd. And they have all of these monthly. It's very easy to see. So I do like how management is putting these up to be transparent, especially for retail investors. Last, you must consider which tax bracket you are in to see what percentage you have to pay with qualified and non-qualified dividends. For 2022, qualified dividends are taxed at 0% if you are single and make less than $41,675. If you are making $41,676 to $459,750,000, you will pay 15% on qualified dividends. If you're making more than $500,000 a year, call me. Unless you're making $459,751 or more, you won't pay that much in taxes. Of course, this is for someone who is single. It's different if you're married, filing jointly, married, filing separately, or head of household. For non-qualified dividends, taxes are higher. Non-qualified dividends are taxed at the same rate as an investor's ordinary income tax rate. If you make less than $10,275, you will pay 10%. 12% is up to $41,775. 22% is up to $89,000. 24% is $170,000. 32% $215,000. 35% $539,000. If you make $539,901 or more, you will pay 37% in taxes, and that is the maximum tax bracket. Taxes are a bit confusing, so make sure to talk to your tax professional before listening to a rando on YouTube. Me, I'm talking about myself. It's time for the final countdown. Who wins the best returns in a 10-year period? It's time to find out. In this corner, we have the overall stock price return showing ticker symbol SCHD with a beautiful 100% return over 10 years. VYM comes in second with a 66% return. QYLD comes in last with a negative 30% return, most of it due to this year. Jepi gets the consolation prize because it hasn't been on the market for 10 years. It currently has a return of negative 10%, so some nice downside protection. So if you want a solid dividend ETF that has a steady increase in share price, ticker symbol SCHD and ticker symbol VYM appear to be good choices. Now, let's look at a hypothetical scenario so we can find out the dividend returns and which one is the winner for that. So let's look at a $10,000 initial investment for the past 10 years. The laggard QYLD has paid an average 10.47% dividend yield found on Y charts for the past 10 years. So a $10,000 investment with dividends reinvested would lead to a total of $28,391.06. Looking at the Ravenclaw, ticker symbol JEPI with an average yield of 7.5%, we will get a total of $21,120.65. The Hufflepuff, ticker symbol VYM, with an average dividend yield of 3.04% would provide a total of $13,483.49. For Gryffindor, SCHD, with an average dividend yield of 2.93%, we would receive a total of $13,390.12. Therefore, we did a complete 180. So if you want more income monthly, QYLD is the way to go. Please just keep in mind the principal could diminish, you may have to pay more in taxes, and there is a higher expense ratio. Overall, each dividend ETF offers unique benefits for different type of investors. If you're looking for more solid and increased returns with less volatility, SCHD or VYM are great low-cost options to help you sleep at night. While Jepi is the newest kid on the block, it provides nice downside protection, and it allows for a higher dividend yield. This is a great choice for dividend investors who want a higher yield and don't want the stock price to drop too much. For dividend investors who want a high yield and don't mind big drops, QYLD may be the right option for you. Just keep in mind the yield may go lower as the bear market continues. So with my top 4 dividend ETFs, you can see that there is a wide array of metrics that you need to know, but all in all of these dividend ETFs are Raylan approved, so go at your leisure to get them. They're just a little bit riskier or a little bit safer and have a few different metrics to look at depending on what type of investor you are and what you need for your specific portfolio to balance it out. So now you may be thinking, okay, this is all fine and dandy, but you're probably thinking, how did this happen? What are the metrics to use? How can I learn to fish? I'm not just going to give you the fish, I'm going to teach you how to fish. Here are the top 5 most important key metrics to look for while finding the best dividend ETF for your portfolio. Number 1, dividend yield. Dividend yield is essentially the moneymaker. It is a percentage that shows how much a company pays out in dividends each year relative to its stock price. So with ticker symbol SCHD, we have a 3.19% dividend yield. So for every 1 share of ticker symbol SCHD, which is currently $71.12, we multiply by the 3.19% dividend yield and get $2.26. So each 1 share of SCHD will pay us $2.26 in dividends each year. It is very important to look at the 5 to 10 year dividend yield. We like to see consistent dividends that do not show dividend cuts or times when the company decided not to pay a dividend, which definitely happened during 2020. This may trigger a red flag and show management was unable to handle company problems or economic headwinds, and obviously we should give this a pass during 2020. Further research is needed if we find these red flags. Past success does not guarantee future success, but it usually indicates of a median dividend and if we should expect steady cash flow or not. Number 2, dividend growth. Has the dividend increased over time? Dividend growth should show steady increases over time, especially over 10 years of returns. As the company shows steady and reliable revenue increases, dividends should increase as well. Showing robust dividend growth shows shareholders' management takes investors seriously, and this is likely to continue. Number 3, price volatility. Is the stock price actually stable or is it volatile? While the dividend may be more important for your portfolio, the stock price should be important as well. Looking at a 5 to 10 year chart, we need to see the stock price going up or down to get a sense of how the company is doing as far as investor sentiment goes. We need to find out why investors are negative or positive about the company. We also must note if the price has a consistent uphill trajectory or if we see large swings during volatile times. If you're looking for a steady price, even in times of bear markets, you need to see how well the stock has done for the past 10 years when we had 2008 and 2020. If you get queasy with a 40% drop, you may want to stick with SCHD or VYM as opposed to qyld. Number 4, expense ratio. Say this with me. Low cost funds only. Before cost, beating the market is a zero-sum game. After cost, it is a loser's game. This quote is from the legendary Bogle, who spoke quite negatively about costs. Expense ratio measures how much you'll pay over the course of a year to own a fund. This pays for management, ads, and costs. Mutual funds and ETFs typically charge expense ratios. Beware of high expense ratios and try to only invest in low-cost ETFs. You can find this information easily on Yahoo Finance. Ticker symbol SCHD and VYM both have an expense ratio of 0.06% while having a lower yield than qyld and jepi that has a higher expense ratio. qyld has an expense ratio of 0.60% and jepi respectively has an expense ratio of 0.35%. These two may seem high, but their yield is much higher, so we will let it pass. And number 5, my professor would not be very happy with me if I did not recommend this. Tax implications. Taxes are super important when investing in dividends. It's like peanut butter jelly time. We will talk about this later, but it's important to know what type of taxes you will have to pay in dividends each year. Dividends can be classified as qualified or non-qualified dividends. Depending on the tax type, you could be paying substantially more than if you had bought a different asset. With these metrics, you can get a better idea on how to invest in dividend ETFs. Of course, researching the ETFs, its strategy, and its holdings should encompass your time as well, but these metrics are very important. So much to learn, so little time. Now you know my top personal 4 dividend ETFs that every investor, I believe, should have in their portfolio. You should choose at least one that you love. I have all of those in my stock portfolio, and I will be doing a reveal sometime soon. Just comment below what stock you would like me to go over next, and I wish you very well. This is Supergirl Investor here to save the world and make you wealthy, and hopefully you learned a little bit. Please like, please subscribe, please comment, all the things. And I just hope you have a very wonderful week, a safe, healthy week, and let's crush it and make some money and have all parents in yachts by 2025.